This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
So we got sectors breadth and the gold option skew. Listeners, you'll find the download link in your Research Roundup email. Now, if you don't have a Research Roundup email, it means you haven't registered a free account at macrovoices.com. Don't worry, we won't spam you or try to sell you anything. What we will do is send you links to all of our cool content, like these downloads. You can sign up at macrovoices.com. Just click the red button that says looking for the downloads. Patrick, sectors breadth and gold option skew. Let's hit it.
All right, well, let's jump straight to the first two charts on page 2 and 3. One is the S&P 500, and the other one is the S&P 500 equal weighted. And one of the issues with a market cap weighted index like the S&P is that it's very heavily weighted to the big behemoth, very large capitalized stocks like Apple and Microsoft. And so what we can see here is the S&P 500 looks very healthy in a proper uptrend. Everything is working fine. But when you look at page 3 and look at the equal weight index of the S&P 500, there has been absolutely no progress since May on the upside of the broader market. This has really been an incredibly narrow rally, and this type of a chart really shows it. And a chart that looks very similar to that equal weight ETF is, of course, the Russell 2000, which a lot of people talk about, and where you can see the overweight into those kind of FANG style stocks is in that NASDAQ that's been running so strong. And this really continues to be an interesting thing to watch, because when you look at global developed markets, not even and even emerging markets on a broader scope, you see the same pattern, which is, the Euro Stock 50 stopped making higher highs, the Nikkei stopped making higher highs, the emerging markets as an ETF, the EEM, stopped progressing higher. You really have the entire stock market really have gone through 3-4 months of more sideways chop, while the S&P 500 and the NASDAQ, driven by these FANG stocks, continue. So that breadth deterioration continues. And so when we look at page 4, we can really see this is the New York Stock Exchange, the percentage of stocks above their 50-day moving average. I like this is just because it's simple. It's like stocks that are in an uptrend will typically be trading above their 50-day averages. And so for the fact that we are down to 42% of stocks above their 50-day moving averages just shows you the deterioration of breadth. I mean, we have had a sequence of lower breadth numbers since November, December, and this deterioration continues, and we're not oversold enough to really signal some sort of great buying opportunity. And so the question that continues to be on my mind is this the canary in the coal mine? And usually you would think that if there was another substantial leg higher in this market, it should widen the breadth and have a stronger participation. And we're just not seeing any sign of that. And when I wanted to move on, and when looking at page 5, I just really wanted to show Apple, because Apple or Microsoft, they have a very similar chart, which is that they've had this extraordinary run in the last 5-6 weeks, and they have continued to be the leadership. But the thing is that you can't really basket Apple and Microsoft and Facebook and these FANG stocks with the broader technology basket, because when you look at page 6 and let's say take Kathy Wood's Ark Innovation ETF, the ARKK.
Now, Patrick, in the interest of transparency, are you an investor in Ark?
No, I'm not.
I'm not either. I just wanted to make sure that we were clear about that.
Okay. All right. So, but anyway, when looking at this Ark, the highs came in early in the year. And even though it tried to rally here in the last month, and on a percentage basis, it certainly has made a reasonable run, up 20+% in a month off that low, we're not making higher highs. And how quickly has rolled over and started selling in the last few weeks. And when you even take a global social media and you take everything from the Alibabas to Baidu's to the Tencents, like the Chinese internet stocks and things like that, making lower lows. This is really a very narrow market. It's not even just being in long-term growth and technology. It's really been about being long FANG. And that really hasn't changed. And to me, at least that's making me pay attention because, it doesn't seem right to be for it to be trading this way. And I think that the stock market has a lot of hurdles ahead of it if it can't widen this breadth.
Well, Patrick, I've gone well out of my way in past episodes to acknowledge Cathie Wood for having really made a lot of money with her strategy. And I do that because I'm looking forward to telling the other side of the story when this all falls apart. I'm going to just throw in my commentary here. If you look back at post-87, everybody looked back at portfolio insurance and said, how could we possibly have ever been so stupid as to not recognize what George Soros called reflexivity, that the presence of that insurance product that was designed to protect against a market crash would actually be the cause of the market crash, and that it would exacerbate the market crash because of the need to continuously, continue selling S&P futures into a crashing market. My prediction of the next time that the entire finance community just cannot believe how stupid we all were, most of them anyway, is when we finally figure out that passive investing and the trend toward almost all of the market being passively invested, so there is no efficient price discovery of individual issues, and all of the speculative money gets thrown in to either the FANG stocks or the ARK funds and the things that are doing sexy Elon Musk is going to send a Tesla on a spaceship to Mars because he's going to sell you tickets to his nightclub on Mars. It's coming, trust us. Someday we're going to figure out that the whole market being obsessed with this indexing fad, which never made sense, plus the people who are not indexing just speculating wildly on these stocks that don't make any sense. That's going to be even stupider in hindsight than portfolio insurance was. That's my prediction. But so far, Cathie's made a lot more money for her investors than I have, so I acknowledge her accomplishments to date so far.
All right. Well, let's move on because I wanted to touch on crude oil for a moment. So we were just talking about the idea that crude oil may at least pause here and backfill, and there could be a potential correction. But I wanted to just circle back to the point we were making over the last couple of weeks, which was the fact that the oil and the energy stocks themselves. A couple of weeks ago, we looked at not only just the majors, but we looked at the exploration companies, the refiners and oil service providers, and they all have been correcting ever since the start of June. And that trend continues as there is definitely an outright distribution in this space. And this is interesting to me because we have seen usually a pretty strong correlation between energy prices in the commodity space and the energy sector stocks moving together. And the fact that the energy stocks have all rolled over a month ago, I continue to ask the question as to what is the driver, and is one leading the other? Is it simply that there's enough people nervous about the reflation trade forcing a rebalancing of how much of an overweight they have in this energy sector? I'm not sure, but it really is interesting that these energy stocks continue to be quite actively distributed off their highs in spite of oil's recent strength.
Well, Patrick, it's going to be real interesting, but I think inventory is going to be the tell. What was going on in the crude market is everybody was panicking because OPEC could not come to a deal, and everybody knows that the crunch is on. Now, what I think is interesting here is everybody's relaxing. OPEC, it looks like they're going to make a deal. Look, the crunch period really is through Labor Day, summer driving season, although Phil Verleger told us, be careful, that's actually summer home building season. So, and I think that could be extended this year. But even so, Patrick, I think what big picture is going on here is everybody is like, oh my gosh, the summer crunch that we feared in terms of inventory is going to be better because OPEC's going to make a deal. Look, if OPEC makes a deal tomorrow and they start increasing production, the lag time for that oil to get into the market and actually be delivered is not going to overcome any kind of crunch that might have occurred in August. So what happens in August is still, I think, set to happen. I don't know how bad the inventory draws are going to be. We'll see what happens, but I don't think there's any reason to think it's all over. Where I do want it to be all over, though, Patrick, Patrick, is lumber futures. So let's move on to page 9, because building construction is just so busy and booming these days. But it's interesting. It seems like maybe the bubble in lumber prices has been averted, perhaps because there have been improvements in the logistics as we're coming out of the pandemic slowly. What do you make of it reversing so much?
Eric, it definitely had a supply issue, maybe driven by COVID. But what is clear is that supply issue has now been cleared, because when you look at these futures, I mean, we went from a November low of $500-600 up to $1,800 on lumber. And that was one of the things that everyone that was crying secular inflation was pointing to, and how quickly lumber has gone from $1,800 back to $600 and just wiping out an unbelievable $1,200 off the high. And it seems like everyone stopped talking about it as an inflation risk. I don't know if I want to overread into it, but it certainly is amazing to see this parabolic rise and how rapid that mean reverting correction back to long-term average prices has happened. You know, if you go and look at even a 20-year chart of lumber, that kind of $200 to $500 range has been a long-term kind of trade range for lumber prices. This breakout to 1,800 was an extraordinary breakout out of that long-term average, and it really looks like we're coming right back to test that trade range, at least to test whether or not that 500-600 level, what was overhead resistance, now could potentially act as support. One way or another, very oversold market. You would think that at some point it's going to even offer some sort of a reactionary bounce, but the selling just seems relentless. It's pretty amazing that this one commodity it's one of the few commodities that goes limit up or limit down on such a regular basis. Just the volatility in this commodity is extraordinary, but we're down here. It'll be really interesting to see whether or not the support kicks in the next $100.
You know, and we're down 65% by my reckoning from that high. That's really a big move. And I feel sorry for the guy who signed the contract on the house at the peak and paid those lumber prices built into his house price. Let's move on to one that I think most of our listeners are hoping is going to go up quite a bit more. That's gold futures. It really looked like the bull market was on again until we had that one FOMC statement that just crashed the market. What do you make of this?
Well, I don't think we need to repeat what we said in the market wrap at the beginning, which is that we're at a critical moment here around 1835, 1840, where if the bulls are going to make a trend out of this, we're going to beat this level on the upside, and it's a very critical pivot to find out. What I just really wanted to observe is that overall, the gold miners using the GDX ETF have more or less traded in line with gold, which is what we typically see, and what I, let's say, for instance, would have expected the energy ETFs to be behaving similarly to oil. And nonetheless, gold and gold miners are really kind of trading in check. Gold miners haven't really turned up just yet, but showing signs of breaking out. But really, what I wanted to kind of use this simply as a reference point to talk about the gold options market, because Aaron referenced it when you asked him about how to put on gold or what his view on gold is. He immediately referenced risk reversals and spread trades that can be done on gold, and largely because of the skew. And this is something that I've spent a lot of time doing presentations on at different shows, and I just thought it was a great opportunity for us to circle back and talk about the nature of the options market on gold. And so what I wanted to just start with on page 12 is just showing a skew, and I wanted to go out something close to 6 months. In this case, we're going out to January 21st of 2022 into the first month of next year on the GLD, which is the ETF on gold. And what we're showing here is the skew that at different strike prices, what is the implied volatility being priced? For many people not familiar with the options market, they would perceive volatility to be linear in a sense of just like a VIX level, where if you look and it says the implied volatility is 15, you would think that all strike prices have have the same implied volatility. But in fact, when you go to different strike prices on options, each one has a different implied volatility based upon market conditions and supply and demand and other variables that come into play. And what's interesting about gold and the volatility skew is it's a beautiful smile or a U shape in the skew. And to give reference to this, if you were to, let's say, overlay the skew on the S&P 500, it has a huge fat left tail and a downward sloping right side of the skew into 5% out of the money strike prices. What this implies is that it's very cheap on the S&P 500 to buy call options, and it's relatively more expensive to buy downside protection or insurance. You have to pay up additional volatility premium to buy protection on the downside. But when we turn to the gold market, and what I'm showing here is that you have a very robust volatility premium on the calls on the upside that are out of the money, just as you do on the downside on the puts. And this is where Aaron was referencing the idea of using things like debit spreads or risk reversals or collars to hedge out gold positioning, which I think is something I continue to be a very big fan of. And we even have a big picture trading a number of positions on in this manner. And so what I wanted to just do for our listeners is to just pull up on page 13 the January 2022 options chain. And I just chose $10 strike increments just so that we have less things to stare at. And I just wanted to kind of talk through a couple of these different strike prices to just show the different asymmetry that exists in this. And so as an example, let's say one was forecasting that by the end of the year, over the next 6 months, there could be a 10% rise in gold prices. And let's say you think it's reasonable that the GLD will approach $190 on the upside within the next 6 months. Doing a, let's say, 180 to 190 bull call spread right here is just under $2. And so one could pay out a $2 debit for up to a $10 payout, getting a 4-to-1 payoff profile on the upside. And even if you wanted to be bold and let's say bet on a 20% rise of gold by the end of the year, you could let's say do in this example a 200 by 210 bull call spread for essentially 50 cents for a $10 payoff, and even have the potential of a 20-to-1 payoff if there was an extraordinary bull run on the upside of gold. Now, it's not that these things are guaranteed to pay out, but it's incredibly cheap to put these bets on. And so anyone who's trying to hedge out the idea that have some upside on gold and don't want to outlay all the money of a big portfolio allocation, the option market is very friendly to buy upside potential on gold here.
Okay, Patrick, sanity check. Everything you said about option skews lined up with my understanding, much of which I learned from you in previous episodes. But in past episodes, when we talked about option skew, you also brought up collaring gold with options. And I noticed you didn't mention that. Is that because you don't think it's conducive to this market or what?
No, it's still actually a great trade, and there is still a very natural and favorable setup here. As an example, let's just say you take the GLD and you want to, and you physically own the gold miner shares. If you wanted to insert a collar for hedging it out, and let's just say right now we're trading near 170. I'm going to do rounding numbers, but we're near 170. Let's say you want to hedge $10 lower, but you want to sell a call to pay for that premium $20 higher. And so right now a 190 call pays you out $240, and a 160 put is just over $3. So under a dollar debit, you can have a collar in where you have almost twice as much upside as you have downside risk before the hedges kick in. It's still a really nice collaring skew for the gold market, and it's still one of my favorite ways to take overweight positions in gold. This is that if you're going to be overweight and increase concentration risk, you might as well use the options market as a tool to manage or hedge out some of that risk. And the options market in gold continues to offer so many great opportunities for that.
And of course, our pro option traders already know that, but for some of the retail audience, they don't. The solution for you is page 14, where you can sign up for Patrick's service for a free 14-day trial and get webinars and chart decks with Patrick every single day. That's on page 14 or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from bigpicturetrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.